Let me ask you something. If I told you that you could buy a home in Seattle right now with as little as 3.5% down, would you believe me? Most people wouldn't, because somewhere along the way, everybody heard the same thing. You need at least 20% down to buy a house, and that number just stuck. But here's the truth. That rule is outdated, it's a myth, and it's one of the most expensive myths in real estate, because it's keeping people on the sidelines for years while they try to save for a number that they don't actually need. Today on Signed and Funded, we're going to break down the 20% myth for good. I'm going to walk you through what your actual minimum down payment options look like, explain PMI, which is what freaks people out about putting less down, and show you that there's real money available to help first-time buyers that most people don't even know exists. By the time this episode is done, you're going to know exactly how much you really need, and you might realize you're a lot closer to buying than you think. I'm Scott Alfano. I'm a licensed real estate agent in Seattle and a loan officer across the country. This is Signed and Funded. So where did the 20% rule come from? It's actually not made up. It was real at one time. Before the 90s, most conventional lenders required a full 20% down. That was the standard, and if you didn't have it, you had a much harder time getting a mortgage. But the mortgage market evolved, loan programs changed, government-backed options expanded, and today, 20% is not a requirement, it's a choice. A perfectly reasonable choice if you have the funds and you want to avoid paying PMI, but it's not the only path to home ownership. What does putting 20% down actually get you? To be clear, putting 20% down is not a bad move. Here's what you get if you do it. You avoid private mortgage insurance. That's the PMI that I've mentioned a couple of times already. Your monthly payment would be lower, and you usually get a slightly better interest rate. Those are the real benefits of putting 20% down. But if saving 20% means waiting 4, 5, 6 years to buy, especially in a market where prices are trending up, you could be losing more to appreciation and lost equity than you ever would have paid in PMI. And that's the math most people don't run. They think they're being responsible by waiting, but depending on your situation, waiting might actually be the more expensive decision. I've encountered a lot of people that have that number in their head. I need 50 grand down to buy a house, and they wait those 4, 5, 6 years to get to that number. And then by the time they do, that is no longer the number they need. Now it's more like 65, 70. And if they had bought at the time they wanted to, 4, 5, 6 years ago, with 5% down or 10% down instead of waiting to get up to 20, they would already be in a home. They would be gaining that appreciation for their own wealth, and they'd be in a much better position moving forward. Okay, so what are your actual options? Let me walk you through the main loan programs and what they require. All right, I'm going to dive into a little bit more detail on each loan type. FHA loans, starting at 3.5% down. FHA loans are backed by the Federal Housing Administration, hence FHA. They're one of the most popular options for first-time buyers. The minimum down payment, as I mentioned, is 3.5%. So on that $450,000 home, that is $15,750. To qualify at 3.5%, you need to have at least a 580 credit score. If your score is between 500 and 579, you can still get an FHA loan, but your minimum down jumps up to 10%. So if your credit is in that range, we would talk about whether it makes more sense to wait and improve your credit or to move forward with the higher down payment. An FHA does require mortgage insurance, both an upfront premium and an annual premium that gets split into your monthly payments. And it's worth knowing about, but for a lot of buyers, the lower down payment still wins. Conventional 97, 3% down. So this is a conventional loan with a minimum of 3% down. So on this $450,000 home, that would be $13,500. You would need a credit score of 620 or higher, and your income has to fall within a certain limit depending on the area that you're in. Fannie Mae's Home Ready and Freddie Mac's Home Possible are the two main versions of this, and they're both designed specifically with first-time and lower to moderate income buyers in mind. The PMI, the private mortgage insurance, is required here too, but it can be canceled once you do hit 20% equity, and I'll talk more about that in a minute. VA loans. 0% down. If you're a veteran, active duty, or a qualifying spouse, you may not need a down payment at all. VA loans are one of the best mortgage products that exist. No down payment, no PMI, and typically competitive interest rates. If this applies to you and you haven't used your VA benefit yet, this is something we need to talk about. USDA loans, 0% down. So, USDA loans are backed by the Department of Agriculture and designed for buyers purchasing in eligible rural and suburban areas. So, here's what surprises people. There are a lot of areas that qualify that people wouldn't expect. We're not just talking about farms. There are parts of the Puget Sound that definitely qualify for USDA. 0 down, income limits do apply, and the property does have to be in an eligible area, but if you check both of those boxes, this is a really good program to look into. All right, so let's focus on PMI, private mortgage insurance, because this is the thing that makes people nervous about putting less than 20% down. So PMI is insurance that protects the lender, not you, if you default on the loan. So when you put less than 20% down, the lender takes on more risk, and PMI is how they hedge that risk. You pay for it as part of your monthly mortgage payment. How much you're going to pay for that is typically between 0.5 and 1.5% of your loan amount per year, depending on your credit score, your loan type, loan to value ratio. So on a $400,000 loan, that could be roughly $160 to $200 a month. It varies, but that's a pretty realistic range. The key thing that most people miss, PMI is not permanent. I talk to people about this all the time. Um, it's hugely important and it's a huge help, and it will save you thousands over the life of your loan. On conventional loans, once your equity reaches 20%, whether that's through payments, through appreciation, or a combination of the two, you can request that PMI be canceled. And by law, lenders are required to automatically cancel it when you reach 22% equity based on the original purchase price. FHA mortgage insurance is a little bit different. Depending on your loan term and how much you put down, it's harder to remove. It could probably stay on for the life of the loan. But if your equity and credit improve down the road, you can always refinance into a conventional loan to get rid of that mortgage insurance. That's a super common strategy, and it's a piece of the picture that not everybody realizes. It's a creative way to lower your payment down the road and still get into the house that you want right now. So the bottom line on PMI, yes, it definitely costs money, but it's also what makes homeownership accessible to people who don't have six figures in the bank. It has a real purpose, and for a lot of buyers, paying for it for a few years while they're building up their equity is a completely rational trade-off. So there's real money out there, and most buyers don't know. So here's something I want to say clearly. There are programs designed specifically to help first-time buyers with their down payment. We're talking grants, forgivable loans, deferred payment loans that can cover some or all of your down payment and closing costs. These payments are offered at the federal level, the state level, and the local level, and they change frequently. In Washington State, we've got the Washington State Housing Finance Commission, and they offer programs worth looking into. King County and Pierce counties have their own programs. There are also employer-based programs. There are programs tied to specific loan products. I'm not going to give you a specific program and a dollar amount today and have it be out of date 6 months from now, especially because I cover loans across the country and you guys are across the country. What I am going to do is tell you that if you're a first-time buyer and you haven't asked your loan officer about down payment assistance programs, you could be leaving real money on the table. This is one of the more underutilized resources in the mortgage world. People assume that they don't qualify, or they assume that the process is really tough and complicated, or they just don't know how it exists and they don't want to bother starting. But I've had clients get thousands of dollars in assistance that they did not have to pay back. When you're talking to a loan officer, or when you're talking to me, ask specifically about down payment assistance programs in your area. Your income, your location, whether you're a first-time buyer, whether you might be buying in a targeted area, all of that factors into what you might qualify for. It's worth the conversation. Always have the conversation. So, after all that, how do we figure out what is the best option for you? Here's the honest answer. It depends. It depends on your credit score, your income, your savings, where you're buying, whether you qualify for VA or USDA, what your monthly budget looks like, and even how long you want to be in the house. There isn't a single right answer. But here's the framework I use with every first-time buyer that I work with. These 3 questions. 1. What is the minimum I need to get into a home I actually want? That helps to set your floor. 2. What can I comfortably put down without wiping out my emergency fund or leaving me cash poor? You never want to put every dollar that you have into a down payment. You still need to have reserves because life happens. 3. What does the monthly payment look like at different down payment amounts, and which number lets me sleep at night? Those 3 questions tell you more than any rule of thumb, and working through them with a loan officer before you start shopping is the right move. If this episode cleared something up for you, or even sitting on the sidelines because you thought you needed 20%, I would love to hear about it. Drop me a message on Instagram at signedandfunded, or reach out directly through the show. I'm a loan officer, I run the numbers for a living, and I'm genuinely happy to take a look at your situation and tell you where you stand. If you found this information useful, please share it with somebody who's thinking about buying. One episode shared with the right person could literally change their timeline. Next week on Signed and Funded, we are going to talk about what first-time buyers consistently forget to budget for. The down payment gets a lot of the attention, but the true cost of home ownership goes way beyond that, and we're going to break it all down. Thanks for listening to Signed and Funded. I'm Scott Alfano. New episodes every week, one topic at a time, so you always know exactly what you're getting. Until next time, go make a good move.